All right, guys, welcome back. So, in the last session, we are done till question number 47, correct? This 47 question was finished. All right. So, today we'll continue with question number 48. You guys are ready? Okay. On April 1st, 2019, a 8% convertible loan with a nominal value of 12 lakhs was issued at par by Cargo Limited. So, you issued what? Loan. Okay. Convertible loan with a nominal value. All right. It is redeemable on March 31st, 2023. All right. So it's almost like 4 years. Okay. Also at par, redeemable at par only. Alternatively, it may be converted into equity shares. Okay. On the basis of 100 new shares for each 200 rupees worth of loan, which means you divide it with 200 into 100. That's it now. Right. For each 200 rupees worth of loan, you'll be having 100 shares. Right. So therefore, it is fixed. Fixed to fixed test is satisfied. So therefore, we can confirm that it's a compound financial instrument, which means that whatever the relevant accounting that we usually apply for CFI will apply over here. An equivalent loan without the conversion option would have been carried, would have carried interest at 10% uncorrupted interest, to which only we'll be discounting the contractual cash flows to find out the fair value of the liability. Interest of 96,000 has already been paid and included as finance cost. Don't let this sentence confuse you. What do you mean by that? Interest of 96,000 has been paid in advance and it is included as finance cost means you would have recognized that in P&L. You understand the point? So when we try to show the P&L treatment, there we will talk about this particular point. Other than that, it's not at all relevant. Next, present value rates, year end 8% is given, 10% is given. We know 8% is not relevant for us. We know 10% is relevant to discount because 10% is the uncorrupted market interest rate without the conversion option. How will the company present the above loan notes in the financial statements for the year ended March 31st, 2020? Only 1 year he's asking, because it started on April 1st, 2019. March 2020 he's asking, which means 1 year. That's all. Only 1 year. Okay. The most important point that you guys need to understand with respect to this particular question is silent about which party has option to redeem. He said alternatively it can be converted into each shares, right? Sorry, into equity shares. I think this is wrong. All right. It is redeemable or convertible into equity shares. Now the question is, at the option of whom, right? Because the entire accounting changes because of that. Generally, we have to presume that the option is with the holder. Based on that only, we will do accounting. We will not presume that the option is with the company only. So when the question is silent, we'll usually presume that the option of conversion is in the hands of the holder. So this you make it clear. Right. Having said that, now shall we start solving? All right. Now you people tell me how to solve this particular question. Very simple. First, what we will do, we'll take the contractual cash flows. Okay. Right. Which means with respect to the debt part, right? Whatever the interest that they are paying as well as the redemption. We'll take the contractual cash flows. We'll discount it at uncorrupted rate, which is 10% to find out fair value of financial liability. Then based on the total value of the CFI, which is 12 lakhs, we'll be reducing the fair value of financial liability. We'll be getting fair value of equity. That's the usual stuff we have done so far. Same thing we'll be doing here as well. Okay, fatafat I'll do. I'll not be taking much of a time. Okay. Right. No need to copy, just focus. Or if you want, you can copy fast, you can copy fast. Okay, question number 48. I'll be doing it faster. Okay. Right. Anyways, so year will be the first column, 2020, 21, 22, 23. Okay. So we need to take contractual cash flows. What will be the contractual cash flows? How much is the interest that you're paying? 8% interest. Okay. So 8% interest on 12. So 12 lakhs into 8%. Where is my calci? My calci is somewhere. Let me use the phone. Just a second. Yeah. So this will be 96,000 interest. It is given in the question only. But anyways, I just need to show it because in examination also you have to show the calculation. So you put that 12 lakhs into 8%. Got it? Right. That will be our cash flows. Hello, everybody. All right. Now, next year also it's gonna be 96,000. Same stuff. Next year also 96,000. Last year 96,000 will be there. In addition to that, there will be redemption as well, which will be 12 lakhs. The total amount of last year will be 12 lakh 96,000. This will be 2323. Correct? Sir, why did you take redemption option? Very simple. We have presumed that the option is in the hands of the holder. Now you know the concept. If it is in the hands of the holder, he may opt for redemption or he may opt for conversion. We don't know that today. So therefore, we need to consider both the alternatives. Correct? And as a result, what happens if we ask for redemption tomorrow? Then we have an obligation to pay. So when we have an obligation to redeem, we should consider that while calculating the fair value of financial liability. This we have seen n number of times already. Okay. By this time, you guys should be pretty much aware of this. Just a second. All right. So what will be your discount factor? Present value factor at uncorrupted interest rate only you'll take, which is 10%. You'll not be taking 8%. So this will be 0.91, 1 divided by 1.10, Nana. 0.83, 0.75, 0.68, 0.68. Now, don't ask me a question saying that, sir, should we take 2 digits or 3 or 4 or 5? How would I know? How would I know means even you don't know, I don't know, nobody knows. Usually take 3 digits to be on the safer side. Okay. In this question, your ICA has taken 2, therefore I'm taking 2. But in examination, we don't know na, whether you should be taking 2 or 3 or 4. All right, Nana. Now, let's calculate the discounted cash flows. I've already done this calculation. Some students have already done. So let me put the numbers directly. 87,360. Let's not waste time on this, okay? Time is very valuable for us. 79,680. 72,000. Okay, so this total value will be 8,81,280. So total fair value of financial liability will be how much? 11,20,320. Right. So what's your total value of CFI? You can write total CFI value, or you can also call it as initial proceeds, which means totally how much money you have got in the beginning, which will be 12 lakhs in this question, because 12 lakhs only na you have received. So 79,680 will be your fair value of equity. Got it? All right. Easy peasy. So what will be your entry? Bank account debit 12 lakhs to what? CFI financial liability to CFI equity. That's all. We have been passing the same entries, na. See, last sum. They passed the entry in the last sum. Okay, last sum was a tad bit different. Now see, same. So I won't be repeating all those things again. Okay. Other one is, what did he ask you in the question? How will the company present the above loan notes in the financial statements? Financial statement means both the P&L account as well as the balance sheet for the year ended 31st March. That's all he has asked. Okay. So you have the entry. Bank account debit to CFI financial liability to CFI equity. Okay. 12 lakhs. So this will be 11 lakh 20,000. 320, 79,680. This will be your initial recognition entry, correct? Which will happen on 1/4/19. I hope the date is 19 only. Right? Chala. What else? Now we have to show the presentation in financial statements. Na? So what will be the presentation when it comes to financial statements? First of all, we need to show in SPL. What is SPL? Statement of profit and loss for the year ended 31st March 2020. Correct? Now, what is the finance cost to be recognized? Finance cost or interest cost? Or you can also call it as interest expense, or you can also call it as finance cost. You should be flexible enough, Nana, with these multiple names, okay? Don't be very rigid saying that all we know is interest expense. Therefore, we'll call it with the name interest expense only. It can be interest expense, it can be interest cost, it can be finance cost, it can be anything. All these are synonyms, okay? Right. Now, how much is this? Very simple. For first year, it's gonna be, this is the value of your financial liability, na? 11,20,320. How will you pass your interest entry rate? You remember that? To that extent, you'll be increasing your financial liability, right? Interest expenditure account debit to Financial liability, exactly. Right, into what is the interest rate you'll be taking? Exactly, 10%. Good. We'll be taking uncorrupted interest. So this is the actual interest that we'll be recognizing in our books. The contractual cash flow interest is different. That will be depending on coupon rate. This is depending on our own actual rate of interest according to us. Okay. This will be 1,12,032 because it is into 10%. But from this, I need to reduce interest already recognized. This is where that particular statement in the question comes into picture. Usually we'll leave it like that, but now we are not doing it. Why? Because in this question there is a special point. What is that special point? Which some of you might have got confused with. Interest of 96,000 has already been paid and included as finance cost. So because it is already included as finance cost, to that extent I'll be reducing it. That's all. Because this 96,000 is already shown. Then if I show again 1,12,032, which includes this portion as well, then I'll be doubling stuff, right? So therefore, net effect will be how much? 16,032, right? So additional interest expense to be recognized in SPL. What is SPL? Statement of profit and loss. Simple. So usually we'll just write 1,12,032 and we'll leave it, Nana, because in the question he told you that already this much has been recognized. Therefore, again, if I recognize 1,12,032, then I'll be doing doubling effect. You understand the point? Therefore, this much you reduced and this net amount only you will be taking back. You got the point? Yes, everybody, right? Now, one effect is done, statement of P&L. All the financial statements effect we have to show. Na? So what is the next one we need to show? Obviously, balance sheet as at 31st March 2020 or as on 31st March 2020. So in that, this is an extract of balance sheet, okay? Extract of balance sheet. So which means we are showing only a small portion, the relevant portion. The relevant portion only, equity and liabilities. Okay, and that will go for equity. Right, Nana? Even under equity, will be going for other equity. What is this other equity, sir? We are talking about convertible loans, sir. Ah, yes, only. Convertible loan. That will be shown under other equity. You understand the point? Because it has got equity portion. Right. So equity portion will show here. How much is the equity portion? 79,680. We have got it now here. 79,680. That equity portion will be shown under other equity. So even though the total name is so-called loan, but in that there is an equity portion, that equity portion will be shown here. Fantastic. Right. Then what about financial liability? Yes. Non-current financial liability, which is nothing but 8% convertible loan, right? How much will be the value at which you'll show in the balance sheet? Pretty simple. Initial value is 11,20,320. 11,20,320. For that, you will be adding our own interest expense, which is 10%. 10% interest expense is how much? 1,12,032. 1,12,032. And you will be reducing contractual cash flows to the extent of interest that you have paid, your liability value will reduce. What is the contractual cash flows that you will be paying? Coupon rate. What is coupon rate? 8%. 8% into 12 lakhs, 96,000. To that extent, you reduce. Your value will be how much, Nana? 11 lakh, 36,352. That's all. So did we show the effect on the financial statements? Yes, my balance sheet part is done. My SPL is done. Statement of P&L would have been very easy provided if this sentence is not given in the question where 96,000 has already been recognized. And coming on to balance sheet, it's pretty simple only, Nana. Under equity and liabilities, equity will show separately. Liability also will show separately. Why? Because it's a compound financial instrument. Under equity, will show the equity portion. Under liability, will show the liability portion. Of course, it is not a current liability. It's a non-current liability. It is spread over multiple years. Now, obviously, it is non-current. There is no doubt in that. Right. That's it. Are we done with this? Any doubts before we move on to the next question? All right. Next question we are talking about is buyback. Buyback of CFI. Okay, Nana, moving on. Coming on to this particular question 49, we know that this is based on buyback. I hope you guys remember the buyback concept. Anyways, I'll just quickly revise it once. So this is the buyback, which we have already seen. So usually what we do is that first we try to find out, okay, first we need to have a clarity whether holder has the option to redeem, or we have the option to redeem. That is the first point. Once you know that, then what you do is that try to find the fair value of the financial liability and equity. Just like that, usually what we do. Then we pass this entry. Now, this is your initial recognition entry when it comes to compound financial instrument. This is what we have been doing in so many problems so far. So nothing special. Till here, exactly the same, which we already know. But hereafter, in the second step, the things will change. So we know that when it comes to equity part, it will stay put. It will stay put in the sense we'll just keep it like that. Only when it comes to financial liability part, we'll be applying ACM table till the buyback is going to happen. Otherwise, just ACM table will apply and we'll leave it. Correct? So now, if you look at this question, when did this buyback happen? 5 years later. Okay. So therefore, till 5 years, we have to prepare ACM table to find out the carrying amount of the financial liability. When it comes to carrying amount of the equity part, no problem. Why? Because anyway, it will remain the same after 5 years also. But when it comes to carrying amount of the financial liability, that we need to find out. So therefore, every single year, opening balance, our interest expenditure you will add, contractual cash flows, that is coupon rate, you will reduce, you'll get closing balance. Like that, you will do it for how many years? 5 years. And then finally, you find out the carrying amount. You understand the point? Sir, why do we need to find carrying amount of both the financial liability and equity part? Why? Because buyback means basically what's happening. Your entity is going to buy back that particular entity. What are you going to do? You're going to sell them. So when you're going to sell them, eventually what's going to happen? You're going to have a selling price. At what price they're purchasing is going to be the selling price for you, right? So when this buyback of CFI is going to happen, you need to compare the price with the cost. And the cost is nothing but your carrying amount. And the cost is nothing but your carrying amount. So therefore, we need to find the carrying amount or the book value of the financial liability part as well as the equity part. That is nothing but our cost. Then the buyback will happen. We will see the price. And then the price and cost will be compared. And eventually, whether the buyback has happened at a profit or at a loss, we will know. Eventually, depending upon whether the profit is for the equity or the profit is for the financial liability, eventually it will be either transferred to P&L account or retained earnings. We have got that point over here. See. CFA buyback, any excess payment or less payment, that is profit or loss, towards equity owners should be adjusted to retained earnings. Any profit or loss with respect to liability will go to what? P&L account. So now, okay, so once we'll find out carrying amount, after that what we'll be doing here, this is the important point. You can find carrying amount of financial liability in two ways. Way number one is the traditional way, where you'll be calculating the ACM table for 5 years. At the end of fifth year, you'll be having the carrying amount. You understand the point? This is usual way, which we do. Or I told you the other way as well. In this case, for example, this is for how many years initially? It is for 8 years. It is for 8 years, and in the fifth year, he is going for buyback. Which means fifth year, if I want to find the carrying amount of the so-called financial liability, after fifth year, how many future contractual cash flows are there? Sixth, seventh, eighth. Fifth, sixth, seventh, eighth. Is it 8 years or 9 years? All right. 31st 12 2008. So 9 years it is. 1/1/2000 and 31st 12 2008. Okay, if this is also 1/1/2008, then it would have been 8. But here it is 31st 12. So this also should be counted as 1 year. So totally 9 years for you. So already 5 years is done. So in future, how many years you have got? 4 more years. Correct? So in future 4 more years, whatever the contractual cash flows that you have got, that you discount it and bring it down to present value, which will be same as this 904.3. That's what I've done over here. You take the remaining cash flows, that is nothing but future contractual cash flows. You have the interest as well as the redemption, because the option is in the hands of the holder. That's what we have presumed. So when the option is in the hands of the holder, there might be a chance that he will ask for a redemption. Correct? Therefore, we have taken that, and finally we have calculated the carrying amount of financial liability portion. Either this method or this method, both will be same. Many a times we'll be using this method only. Why? Because say for example, if it is a 15-year debentures, for example, convertible debentures, and you're doing buyback at the end of 12th year, then if you go for ACM table, you have to prepare ACM table for 12 years. You understand the point? Which will take a lot of time. Whereas what we can do, you can just come to the 12th year and 3 more years are left over. For 3 more years in future, whatever the contractual cash flows you have got, if you just discount it at the original EIR, you understand the point? What will happen? You will be getting the same carrying amount and you will be saving hell lot of a time. So therefore, there are two ways. One is the routine ACM way to find out the carrying amount or the book value of your financial liability part of compound financial instrument. Or This is the new way, where at any given point of time, carrying amount of a financial liability is equal to discounted value of the future contractual cash flows. There ends the matter. Okay. Once you're done with it, now you know that your cost or the carrying amount of equity portion is 173 and the carrying amount of the liability portion is 905. Now you know that these guys are buying at what? 1450. So the selling price is 1450. The buyback price is 1450. But the problem with 1450 is the price for the compound financial instrument on its totality, which means I pay 1450 and I buy the compound financial instrument. Now the question is, in this 1450, how much price should be allocated to the liability part? How much price should be allocated to the equity part? That we need to figure out, correct? For that, what we will do is that is what we are doing here, splitting the buyback price. Okay, what we need to do is that on that day of buyback, find out what is the comparative rate of interest in the market. So if you can see, on the day of buyback, the company could have issued non-convertible debentures with 4-year life at a coupon rate of 6%. So the comparative interest rate on that date in the market is 6%. Now with 6%, you discount the future cash flows from the buyback date. That is, for next 4 years, interest will be 70 and the redemption value will be 1000. You get this much as the fair value. Now this fair value will be the splitting price. So which means out of 1450, the price at which you bought the entire compound financial instrument, liability portion will be 1035, which is nothing but discounted value of future contractual cash flows, not discounted at original EIR, but discounted at today's, on the buyback date, comparative market rate of interest. On the buyback date, comparative market rate of interest. You understand the point? Now, once you're done with that, from the selling price, you reduce the fair value of the liability part, you get your equity part. These two are your selling prices, 1035, 415. So you have your selling price over here, you have the carrying amount. You got the point? Now you have to think from company's point of view. I've bought this back. I have paid this much for something that is worth this much. Correct? So therefore, this is a loss. Buyback price means I have bought back, Nana. So liability worth is this much. Carrying amount is this much. Whereas I have paid how much? 1035 as a company, right? As a result, what's going to happen? For me, it is loss. For the holder, it is profit. You understand the point? For holder, from investor point of view, it is profit. For me, from company's point of view, it is loss. Therefore, P&L account will be debited, because whatever the gain or loss with respect to financial liability will go to P&L account, correct? When it comes to equity part, this is the worth 173. Here you have, right from day one, it is the same. And what is the price that you have paid for 173? 415. You understand the point? So therefore, I have purchased equity also at a higher price. So therefore, there is a loss. But this loss will go to retained earnings. Therefore, retained earnings will be debited. That's what. You understand the point? So to bank, whatever the amount that you have paid to buy back, and you will be debiting this much, the carrying amount, and the balance is loss in both the cases. In this case, it is loss because we are thinking from company's point of view. If you think the same thing from investor's point of view, it is profit. Because investor, his cost is this much, whereas he is selling at this much to the company, back to the company. So for him, it is profit. But we are not doing accounting from investor's point of view. We always do accounting from the company's point of view. Got the point? Now, did I discuss anything new? No. Already clearly we have learned the concepts. All I've done is I've revised one more time. Why did I revise one more time? Probably two to three classes has passed on. So maybe I have a doubt that you guys would have forgotten. That's all. And now we have got a problem based on buyback, and that is the reason I've just revised it. Okay, I've just brushed up the concepts. That's all. This is not a detailed discussion, because detailed discussion already we have done. So now we have to solve this particular sum. Ready? All right. On 1st April 2014, Shelter Limited issued 5,000 8% convertible debentures with a face value of 100, each maturing on 31st March 2019. All right. So total it is for 5 years. Right. The debentures are convertible into equity shares of Shelter Limited at a conversion price of 105 per share. The conversion price is fixed. So all you have to do is 105 per share, right? Whatever the initial value that you have received, the initial proceeds, you divide it with 105 and that will be your number of shares, which will never change. So it's going to be passing the fixed to fixed test criteria. So therefore, you have equity. Therefore, it's a compound financial instrument. Got it? Right. Suppose if it is market price per share and the amount issue price is not fixed, then what will happen? Then it will become variable number of shares. In that case, it will not satisfy fixed to fixed test. In that case, there is no equity. If there is no equity, there is no CFI. If there is no CFI, there is no question of solving this sum. You understand the point? Here also I've written when issue price is fixed, number of shares is also fixed. Therefore, fixed to fixed test is passed. Now, interest is payable annually in cash. Okay. At the date of issue, Shelter Limited could have issued non-convertible debentures with a 5-year term bearing a coupon interest rate of 12%, whereas you have issued at 8%. So this is tainted interest and this is untainted or uncorrupted interest, which is 12%, which we'll be using to find out the fair value of the financial liability during initial recognition, correct? On 1st April 2017, that is 15, 16, 17, after 3 years, the convertible debentures have a fair value of 5,25,000. Shelter Limited makes a tender offer to the debenture holders to repurchase the debentures for 5,25,000, for which the holders have accepted. At the date of repurchase, so this is nothing but buyback, and Shelter Limited could have issued non-convertible debt with a 2-year bearing a coupon interest rate of 9%. So this 9% is nothing but on the buyback date, what is the market rate of interest? Okay, because on the buyback 2 years is left over for your particular debenture, right? So an comparable 2-year debenture can be issued at 9%, it seems. So therefore you'll be using 9% to find out the fair value. You understand the point? Why do we need to find fair value? Because we need to split the so-called price, buyback price, between the liability portion as well as the equity portion. Just now we have discussed. For that we'll be using this. Show accounting entries in the books of Shelter Limited for recording of equity and liability component at the time of initial recognition as well as at the time of buyback. They have 8% and 9% discount rates are given. That's the question. Okay, I'll just wait for 30 seconds. You finish off reading the question, then we'll start solving. Yeah, we'll solve the question. Okay, patafat will do. All right, Nana. Now let's start solving. What is the question number, Ray? 49. Actually, I think it is 50th question. It's okay. Keep it as 49. Now, tell me one thing. First, what we need to do. First, don't think about buyback. Buyback, anyway, it's going to happen after 3 years. Initially, what we need to do, forget about buyback for the moment and think as if you're doing normal accounting of compound financial instrument. That's all. So what is the normal accounting of compound financial instrument that we do? Same stuff we'll do. So it is not something new. Okay. So initial recognition. Okay. So obviously we need to find fair value of financial liability. That is the first part. Fair value of financial liability portion. How to find fair value of financial liability, Nana? Your years, contractual cash flows. It should be discounted at market rate of interest or uncorrupted rate of interest, which is nothing but 12%. So present value factor at 12%. Then you'll be getting discounted cash flows. You total it up, you'll be getting fair value of your financial liability. This is what usually we have done. Now, year 1, 2, 3, 4, 5. Contractual cash flows first year, it will be interest. How much will be the interest, Nana? 8%. 8% into 5,000 into 100. So 5 lakhs into 8%, 40,000. That will be your interest. 40,000. 5 lakhs into 8%. Second year also it will be 40,000. Third year also it will be 40,000. Fourth year also it will be 40,000. Fifth year it will be 40,000 plus. You'll be redeeming at par only, na? Because we have presumed that the redemption option is in the hands of the. Is that is given? Okay, the question is silent. We'll presume that the option to convert is in the hands of the holders. So if the option to convert is in the hands of the holders, then there is a chance that he'll ask for redemption. If there is a chance that he'll ask for redemption, I need to take the redemption value as well, which is 5 lakh. Got the point? Chalo, this is also 50. So 1 divided by 1.12, that will be your discount rate. Somehow I need to get my calci. Just a second, guys. All right, I've got my calci. So 1 divided by 1.12. So this will be 0.892. Okay. 0.797. 0.711. 0.636 I can take. 0.567. This is also 0.567. All right, this you can also calculate this as a annuity. You understand the point? Annuity in the sense, for 5 years anyway the cash flows are same, na? So just take 40,000, you multiply that with present value annuity factor, which is nothing but 1 divided by 1.12, 1, 2, 3, 4, 5 GT. You got the point? Because the cash flows are same. So that will save time also for you. Okay. So all these things put together, you can do like this: 40,000 into present value annuity factor. That is equal to 40,000 into, what is present value annuity factor? 1 divided by 1.1215. Three 3.6047. I'll take it as 3.605. Actually, it comes 3.6047. So this will be how much? 1,44,200. You got the point? And this will be 5 lakhs into 0.567. 2,83,500. Total will be 4,27,700. This 4,27,700 is nothing but fair value of financial liability. From this, okay, then you take total CFI value. Total compound financial instrument value is nothing but total profits, which is nothing but 5 lakhs. Now I'll be getting my equity component value. How much today? 72,300. Routine stuff. Nothing special here. The only point I could add, probably a little bit special, is that you can just use annuity and then calculate it, rather than wasting your time by calculating each and every year separately. That is the reason I've shown you both. I would rather ask you to go for this option. You get it? Are we done with this? Okay. So let's pass the entry on initial recognition, which is on, what is the date, Ray, in the question? 1/4/2014. Okay. 1/4/2014. So you'll be receiving 5 lakhs of money. So bank account debit to CFI financial liability to CFI equity. You can write like this also, but what your ICA has done is that in the place of CFI, they have written 8% debentures. In the place of CFI, they have written 8% debentures. You can do like that also. Because every single question, the CFI name will change. Now, it can be 8% convertible debentures. It can be some 10% convertible preference shares. It can be anything. You can also use that name as well. Okay, whichever you want. Now, bank account debit, it will be how much? 5 lakhs, because 5 lakhs is the money that you have received. And the 8% debentures financial liability value is how much? 4,27,700, and equity value is 72,300. That's it. Are we done with this? Okay, now let's go to repurchasing time, that is buyback. You can also call it as repurchase according to the question. Now, the buyback, we are doing it from company's point of view. So, from company's point of view, keep this in mind. If you keep this in mind, it will be easy for you to understand. That's what I'm trying to say. So, from company's point of view, ultimately, how to do accounting when you do buyback? Very simple. You need to find purchase price. There I know purchase price, which is given in the question. How much is that? 1450. Is it 1450? Sorry, 5,25,000 over here. Sir, 5,25,000, I know that is the purchase price. That 5,25,000 is what purchase price for the entire compound financial instrument. I need purchase price split between what? The so-called 8% debentures financial liability part, as well as 8% debentures equity part. I need purchase price. Then I need carrying amount for both, which is nothing but book value. Then I'll know whether there is profit or there is loss. Now, when it comes to financial liability, I'll be transferring that to P&L account. When it comes to equity, I'll be transferring that to retained earnings. This is the concept, one line concept. That's all. When you do buyback, so all you need to do is that find out the purchase price already given in the question, sir. Already it is given in the question. You split it between financial liability and equity. Find out the carrying amount. Sorry. Find out the carrying amount of the existing financial liability part of the 8% debentures as well as equity component of the 8% debentures. Then you take out the difference, you will get profit or loss. Accordingly, with respect to liability part, it will be transferred to P&L. With respect to equity part, it will be transferred to retained earnings. That's it. Your job is done. Now the question is, one by one, we need to calculate 4 numbers. Correct? Huh? Totally 4 numbers we need to calculate. So what we'll do is, first we'll start with the carrying amount. Okay. Let's write the heading. Calculation of carrying amount of 8% debentures, financial liability and equity component. Financial liability and equity component. Are we done? Ready? Now tell me how to find out the carrying amount. For equity component, no need to calculate anything because whatever we have calculated already, this will be the value. This will stay put. We need to calculate, logically speaking, only for financial liability. Now, there are 2 ways to calculate carrying amount for financial liability. Okay. Way number 1. Prepare ACM table. In this sum, you can happily do it by preparing ACM table. Why? Because anyway, it is only for 3 years. Na? Way number 2. Discount future contractual cash flows at original EIR. Right from the beginning, whatever the discount rate that you were using. What is the discount rate that you have used here? 12%. So this is also 12% here. In a sense, 12% that is in this case. You understand the point? Your ICA has done following this. ICA has done this. So therefore, I'll be going with this as well. If you want, you can also follow ACM table. In this question, there is no problem. It will not be eating away your time and all that stuff. Either way, whether way 1 or way 2, in both the cases, you'll be getting your answer. There is no problem in this question because it's just 5 years and the future cash flows is going to be only for 2 years. Already 3 years is only done. You understand the point? So if you calculate this way, you'll be discounting future 2 years cash flows. If you go this way, you'll be preparing 3 years cash flows. That's all, na? With respect to ACM table. So there's not much of a difference. Suppose if it is 15 years and here you just need to discount future 2 years cash flow. Suppose the buyback is happening at the 13th year and here you have to prepare 13 years ACM table. Then there is a difference. Then we will specifically prefer way 2. You understand what I'm trying to say? Right. So you try to use your common sense and accordingly you try to what? Decide which one is better, way 1 or way 2. Right. Now, because your ICA has done this, I'm going to follow the same one. But as I told you, you can also follow which one? Way 1 as well, right? ACM table. Now, tell me, what are the future cash flows, contractual cash flows? Very simple. For next 2 years, it's gonna be 40,000. 40,000 is only na yaar, interest for all the 5 years. It's gonna be 40,000. Correct? Right? So 40,000 into present value annuity factor, or it's better you do like this. Why to go for present value annuity factor? Okay, you have to discount it at 12%. Na? Alright, I think we have done the calculation over here. Right, let me put it this way. Alright, so let me put some columns. Years, contractual cash flows. Okay, present value factor at 12%. Discounted cash flows. Years will be 3rd year, 4th year. 40,000, 40,000. 3rd year and 4th year only, na? Sorry, 4th and 5th. 3 years finished na, so it will be 4th and 5th. Right? So 1 divided by 1.12. 0.892. 0.797. So what is that we are doing? We are right now standing at the end of 3rd year. So when you're standing at the end of 3rd year and you're doing this calculation, because when the buyback is happening, now you tell me, at the end of 3rd year, From there to fourth year, how much time it will take? 1 year. So therefore, you will take 1 year discount rate. 1 divided by 1.12. That's all. You got the point. And this will be for 2 years. And fifth year, you also will be having the so-called redemption of the liability component. That also I'll be taking 0.797. Now give me the numbers. 40,000 into 0.892, 35,680. 40,000 into 0.797, 31,880. Right. 5 lakh into 3,98,500. Total 3,98,500 plus 31,880 plus 35,680. 4,66,060. Approximation will be there, Nana. Okay, don't worry about that. Okay, 4,66,60. This will be your carrying amount of what? Financial liability. This is carrying amount of financial liability. You got it? Right. Now what about carrying amount of equity? That anyway we know, 72,300. Where did it come from? Stay put from the first entry. 72,300. That will be as simple as that, right? Let's write the carrying amounts over here. Financial liability, 4,66,000. 8% debentures, 72,300. 8% debentures equity is 72,300. Financial liability of 8% debentures is 4,66,60. Clear? Now moving on to next one. Carrying amount is done, but we need to fill up this purchase price of financial liability as well as equity component. Let's go for that purchase price calculation. So heading will be calculation of fair value of financial liability. 8% debentures. How to calculate the fair value? The same thing, Nana. Now you'll understand why ICA has chosen the second method. Why? Because now it will become easy for us. The same calculation, the future cash flows will be again copy pasting, but instead will not be discounting at original EIR. Rather, will be discounting at what? Today's comparative market interest rate. Today's means where are we right now? We are on the date of buyback. We are on the date of buyback. Now present value factor at on the date of buyback, what is your discount rate? On the date of buyback, on the date of repurchase, the interest rate is how much? 9% in the market. So you should take that. Now you understand why ICA has chosen way 2. Because of choosing way 2, calculation of fair value of financial liability, both of these two, they seem similar, so that it will be easy for you to do the calculation. Here, suppose if you'd have gone for ACM table, then that is also fine. Here you'll be doing this separately, that's all. Now 9%, so 1 divided by 1.09. 0.917, 0.842. This is also 0.842. So 40,000 into 0.917, 36,680. All right. 40,000 into 0.842, 33,680. 5 lakh into 0.842, 4,21,000. So 4,21,000 plus 33,680 plus 36,680, 4,91,360. This is fair value of financial liability component. Now what is the total price of it? Total repurchase price or buyback price, 5,25,000. Then the balance will automatically go to equity, fair value of equity component. My total price is 5,25,000. I need to split it between financial liability component as well as equity component. So I take the future cash flows of financial liability as of today. I discount it at today's market rate. Then I'll find the value of financial liability. Automatically, the balance value goes to equity. So what is the balance value? 33,640. That's it. Correct. Huh? So this will be 33,640. Is that it? And this will be 4,91,360. Okay. Now you people tell. So 4,66,60 has been purchased for this much worth of a debt component. You have purchased by paying 4,91,360, which means loss of profit or loss. How much is the loss? Okay, 25,000. Just a second. 4,91,360. Yes, 4,66. 25,300. This is your loss. Whereas when it comes to equity portion, that's the fun part over here. This much worth of book value equity has been purchased by paying only 33,650. So which means you purchased it at half a price. So you have a gain. Therefore, retained earnings will be credited. So how much will be the gain in this case? 33,8,660. Yeah. Okay. 33,660 will be the gain. Okay. So that's it, Nana. Based on this, we need to pass on the entry. So what will be the entry? Because he has asked you to pass the entry as well, Nana. Journal entries. First, let's start with the liability component. Tell me one thing. How much you have paid to bank for liability component? As a company, you have paid how much? You have paid 4,91,360 to buy. So therefore, that much went out of your bank. 4,91,360. And here, 8% debentures, financial liability component should be debited. Then only it gets cancelled. Should be debited to the extent of what? Carrying amount. What is the carrying amount of the liability? 4,66,60. 4,66,60. So this much you have purchased at this price. So therefore there is a loss. To that extent, debit the P&L account. How much is the loss? We have already calculated 25,300. That is the first entry for liability component. Then the second entry for equity component. Again, how much is the bank amount that you have paid? How much you have paid to purchase the equity component? Here it is less, 33,640. You have paid 33,640 to get 8% debentures within brackets equity component, and the carrying amount of the equity component is how much? 72,300. 72,300, you got it at 33,640, which means you have got profit. So two retained earnings. How much is the profit? 38,660 it seems. That's it, huh? That's it. So in case of equity, you get profit. So what will be your narration, Nana? Being repurchase of the liability component recognized, being repurchase of the equity component being recognized. That's all. Whatever that you're doing, just write it. That will become your narration. That's all. Finish it off.